Hi guys, it's Zhang from Moolahwise.com, and in today's video I wanted to illustrate the impacts of taxes on your money. First, we'll be showing you a simple example of compound interest via a story. Then we'll apply the 25% and 33% tax brackets respectively to show you how much of your money will be eaten away from taxes. Okay, so let's get into it. So before we get into that, would you rather have $1 that doubles every day or $500,000 in cash? So let's look at the numbers. So as you can see, $1 on day one, $1 on day one will become $2, and then $2 will become $4, and then $4 will become $8, and so forth. So as you can see, in day number 10, you're still only at $512. That $500,000 in cash seems a lot better. Even on day number 19, you're still only at $262,000. If you notice that it isn't to the last 2 days in this example that the amount actually surpasses the $500,000 amount. And on day 21, your money will have grown to just over $1 million. So what is the point? This is a simplified version of what we call compound interest. Compound interest just means that your interest earns interest. But what does that have to do with how taxes will impact my money? Because I thought this video, because I created this video, was to illustrate how much taxes will eat away your money if you're not careful. So let's see how the taxes will impact this amount. So let's see what it looks like if it is a tax as earned, or what we call the tax now bucket. If you don't know the difference between tax now or tax later or tax advantage, please watch my other video of the 3 buckets of taxes explained. So as you can see, $1 doubles into 2, and then you take 25% off of that, you'll end up with $175, right? And $1.75 doubles to $350, minus the taxes on that, you'll get $306, and so forth. So you pay taxes as you go, then you'll only end up with $72,000 instead of $1 million. So what is the point? The point is that the taxes acts like a speed bump to the growth of your money. The bigger the taxes, the bigger the speed bump on your money. And guys, keep in mind that this is an example at the 25% tax bracket only. So let's see what it looks like when we do the same example but with the 33% tax bracket. So let's see what it looks like in a 33% tax bracket. As you could probably guess, that you will end up with way less amount of money than in the 25% tax bracket. As you can see at the bottom, you'll end up with $27,362 instead of $1 million, which translates to about 2.7% of the total only. I don't know about you, but I didn't work so hard so I could end up with only keeping 2.7% of my own money. Now guys, keep in mind that this is only an example using 25% and 33% tax bracket. And so if the tax rates are higher, then you will end up with much less than as shown. And keep in mind that this is only an example to illustrate that if you aren't putting your money in more tax efficient vehicles, then you'll lose a big chunk of your money to taxes. So what is the point of all of this? So to wrap up this video, I want you to ponder this question. If you were a farmer, would you rather pay taxes on the seed or the harvest? I know I've used this analogy before, but it bears repeating. If you pay the taxes on the seed, then yes, you can get the taxes over and done with. At least that way you'll know the tax rate you'll be paying. Like I always say, if you have to buy something anyways, then doesn't it make sense for you to pay for it when you know the rate? And in this case, the rate that I'm talking about is the tax rate. However, if you keep deferring the taxes, then you're just letting the taxes compound against you. And the scariest part of this whole thing is that you don't know what your tax rate will be in retirement. And if you don't know what your tax rate is in the future, then wouldn't you agree with me, it is better to pay the taxes when you know the rate? To sum it up, think of rates of return as how fast your money is growing. There's a simple formula to calculate how fast your money will grow given a certain rate of return. If you don't know what this formula is, then watch my other video called The Rule of 72 for a deeper explanation of this formula. While taxes are like the speed bumps to how fast your money can grow. Well, I hope you learned something in today's video, and that is that taxes will have a huge impact on your savings over time. So put your money in more tax efficient accounts like an IUL, only if you want to keep more money in your pockets over time. If you don't know what an IUL is, then watch my other video about what is an IUL to see if it's right for you. We have a mission of educating 1 million families on how money works. Please text me at 415-385-9116 or email me at info@moolahwise.com if you have any questions or comments about IUL that I can answer in my next video. Thanks for listening, and bye for now.